All right, I think we're live here. Let me just double check, make sure we're good volume-wise. Testing.
Yep, I got you.
Okay. All right.
This is the typical options trader. Stressed, frustrated, and uncertain.
All right.
Trader who joins the Benzinga options.
All right, we're all good. Okay, so hey, welcome today. This week we have a great course, great class. We're going to be talking about strong daily charts. We're going to be talking about gap fills and some popular patterns, just touching on some popular patterns. I have just a couple here that I like, that I'm familiar with, and then we got some of the guys here. They may add their own patterns. And we are going to have the CPA today. He did tell me he's in a good area for internet. So that's the class that we got going today. So we're talking about a daily chart. So we've talked in the past, what exactly is a daily chart? We mentioned that a daily chart represents a chart that has candles that represent each of those candles represent a whole day's trading day. So you can have a chart like this, and each of those little candles can be a 5-minute candle, a 1-minute candle, a 2-minute candle. Some people even have like 10-second candles. But a daily chart, each of these candles represent the opening of the trading day and the closing. So when we look at the daily chart, we look at it. We mentioned that we look at it for areas of support, for areas of resistance, for trends. We obviously look at this stock right here. Well, this is the SPY, and we see that it's in an uptrend, right? And you can kind of like build a line here and see that it's an uptrend, and then build a line here, and you can kind of see it's in a channel. And that can help you with your decisions when you're day trading, when you're swing trading. Typically, if you're swing trading, you want to, and you're bullish on it, you want to make sure it's on an uptrend. Then you want to make sure you're jumping in on an area of support. So this is a pretty strong daily chart because it's on an uptrend. And what makes a strong chart, a strong daily chart that's good for us to day trade? That's what we want to know, right? We want to know if we want to jump in a stock. Is it good? Is it a good stock to day trade? Is it a good stock to win swing trade? So there's a few things I like to look at if I'm going to swing trade a stock. First, I like to make sure that it's above your moving averages and there's room for profits until the next moving averages, right? So you got some moving averages here, right? If the stock was down here, like above this red, and let's say this represents a 200, then there's some resistance here and there's some moving averages above it. And it's only like 40 cents in between the entry here or and this here. You may not want to get in because it has like a lot of overhead resistance. So that's some of the mindset with people, right? When they look at moving averages, if they're maybe it's above one moving average, but the moving average, the next one is right above it. So it doesn't give you a lot of room. So I wouldn't consider that a strong daily chart, number one. Then you want to make sure there's good volume. So you want to make sure it's trending, it's starting to trend above the moving averages, and there's volume. You don't want to jump in a stock that's above moving averages, but nobody trades it. It doesn't have any volatility. You need some movement, you need some volume to jump in a stock. And then you want a combination of a strong daily chart and an intraday chart, right? So if you're going to day trade this stock, you want to see that it's strong on the daily. And when you jump in on the intraday, if you're day trading, it's also strong. Like there's an opportunity to jump in. You're not just jumping in for no reason. There's some sort of rationale. It's either breaking out of a previous point of resistance. It's either forming some sort of pattern that you're familiar with, like a pre-market breakout, an ABCD pattern, bull flag pattern, whatever it is. So you want that combination. Then you want to mark a trend line and make sure that the trend line holds. So especially like, let's say you jumped in this stock here, you can kind of mark the trend line. And as long as that trend line holds, then you should stay in the trade yourself. And as long as that, if that trend line breaks, then maybe that's where you want to start taking resistance. You want to identify points of support and resistance here. So you see here, there's these two yellow lines are areas of past resistance, but it broke through it. It broke it here, went below it, and then it broke it. And then these areas of resistance. So this thing was on a major uptrend throughout the last few days. And then on the window chart, you want to make sure there's no support resistance, large scale, and you want to see a higher ATR. So ATR is kind of like how much it trades average, right? So let's say you have a stock that on the ATR, let's say on the average it trades 40 cents a day. Then that's probably a stock that you shouldn't be interested in, right? If it's not a whole lot of movement throughout the day. And let's say there's a stock that trades about $1 a day, right? Like within the day, it moves $1. Then that's good information to know, right? Because let's say you're in that stock and you're up 70 cents, 60 cents already, and it usually doesn't trade more than $1. Then that's something you definitely want to consider. It doesn't mean that it's going to stop exactly in the dollar, but you want to have that in your back of your mind. If it's coming to area of resistance, if it's starting to break the trend, if it's starting to look weaker, and usually daily it doesn't trade more than $1, then that's probably some signs that stock is going to become exhausted, and you should probably consider start taking profit, or just get out completely if you're already up. And I'm gonna pass it to these guys. Anything else you guys want to add to kind of like emphasize what a strong chart is daily and intraday?
Well, so I actually went over this with the community a while back, but we were talking about the difference between the strong lines that you draw, and I always like to preach that your horizontal lines are going to be a lot stronger. Your diagonal lines are going to be a lot stronger than your horizontal lines, and that's just your trends, right? And as long as you make these diagonal trend lines, they're going over a period of time is going to be much stronger. So you have to look at that timeline, and you really have to figure out that are you in just a day trade, or are you going to actually turn this into a swing or a possible swing trade? And, your horizontal lines are very important, but your diagonal lines are even more important. I think that usually what I'll do is I'll end up using horizontal lines for breakout opportunities, and then my diagonal lines to figure out if I'm in the right trend or not. And then if I'm breaking these trends and if I'm breaking confirmation, then, making a position only makes sense.
Got it. Malik?
Sounds good. Yeah, I just sent you a picture actually, that kind of, signifies a daily trend and like an intraday trend. So like I kind of drew on the top, longer time frame means that the trend will last longer, right? So you can see that, on a daily time frame, the trend's actually holding up. Meanwhile, if you just click open original on the bottom, it should like open it. Right. And then, you could tell on the 1 minute chart, it could sustain a trend just between 2 or 3 bounces, and then eventually it's going to break that trend. Meanwhile, on the daily chart, you can basically follow that trend for the next month or two, and it'll be fine. Right. And if you scroll down, there's different kinds of trends, and you want to be able to identify what part of the trend you're in, so you can, plan your future moves. So we have a primary trend, right? The primary trend is just like we spoke about on the daily trend. It's going to respect it. This is the trend it likes to fall back to no matter what, to kind of go back and gain the buyers. Next is the secondary trend. It's the trend within the trend, right? So whether the trend's a downtrend, the secondary trend is going to be those trends that kind of spike up back to touch before the downtrend, right? And inside of those trends is called the minor trend. And obviously, we don't trade the minor trend on a big time frame. That's where we go in for the intraday, right? We find on the 1 minute, 5 minute, it's not going to be clear on the big time frame, but we want to understand where we are in the position of the stock in order to make the next move on the minor trend for the primary trend.
Absolutely.
I love this, man. This is the stock Picasso right here.
No. Hey, this is actually how they made the movie Inception.
This is great.
You like my charts?
I love it. No, I love it. So this is great. No, so this is helpful, right? So you're knowing the overall trend, right? And then here you're knowing that the overall trend. So if you know it, you want to try to get into the bottom of that area to catch the wave back up, right? And I love it. This is great information, man. So guys, looking at this like on the chart wise, you're looking at it like long term, right? So the overall trend here, right, it's that it's up, right? This is the primary that he's talking about. But then these little dips, this is like where you want to try to catch those little dips once you identify the overall trend and like catch it on the up wave. Yes, sir.
Exactly. And inside those dips are those little, minor trends that you wouldn't be able to see on the long chart.
Yeah, absolutely. I love it. I love it. That's great. Where were we here? Okay. So okay. So one thing I want to talk about that I think most traders know is what they call like gap to fill. Clear trigger price at the beginning of the gap, above the moving average, next resistance a couple dollars away. So here, look at this chart, right? You see this big drop here. Now, what I know, for most traders, they like seeing these gaps because usually these gaps fill. What that means is that this big gap, it dropped for whatever reason. Maybe they announced earnings and earnings weren't like what the analysts expected. It was lower than expected, or maybe just the EPS was lower than the analysts. Which really, a lot of times with companies, EPS being lower than expected isn't really a big deal because it's for accounting purposes. So, but anyways, but when analysts see this, they'll be like a big drop, right? Whatever they announce, it caused a big drop. So a lot of times for swing traders, they'll see this gap, and you see here, look, it's above these moving averages. The volume's moving up. It seems like it's on an uptrend. I might put a line right here because I'll say like I can assume that this gap is going to fill, meaning as much as it dropped, eventually, as long as like fundamentally something hasn't gone crazy, this is where fundamentals and swing trading kind of mix. If this drop happened because a pharmaceutical company lost their FDA, or they didn't get FDA approval and they're probably going to go bankrupt, or something major, or like Domino's is going out of business, or whatever it is, then maybe that gap will fill. But if it's just an over exaggeration, an overreaction because of EPS earnings, right? Like people put too much emphasis on EPS analysts, then it more than likely it may feel like in the future. So what that means, it dropped this much, and then you see here it's starting to uptrend. It's above some moving averages. I would jump in and I would probably take profit at the top of this gap because I'm assuming that eventually this gap is going to fill. And yeah, so if you are going to go that route, just make sure that fundamentally something hasn't changed that caused this major drop.
Yeah,
If
do you
nothing,
remember Viacom? Viacom had that huge drop, never filled the gap. I mean,
absolutely.
It was a large gap to fill too, but the fundamentals changed. It never rebounded.
Absolutely. Yeah. So that's important, making sure you understand why did it drop. If it's just like I said, if it's just some sort of missed earnings, I mean, that stuff happens, and like people get over that and then they start buying the stock once that stock does well again. Anything else have to add with the gaps to fill?
Yeah, just pay attention to those fundamentals, right? I mean, that we talk about that all the time. If, like, for instance, when AT&T, cut its dividend in half, right? The fundamentals change of that company, and so filling that gap becomes a stronger and harder path to recover from. So, just pay attention to why it dropped, and then if it's something that's a little smaller, for instance, earnings or missing an earnings report, a quarterly earnings report, not a big deal. Usually that recovers.
Yeah. So in volatile markets, traders can benefit from large jumps in asset price if they can be turned into opportunities. Gaps are areas on the chart where the price of the stock or of the financial instrument moves sharply up or down with little or no trading in between. So there's different types of gaps. They kind of break it into 4 classifications. Breakaway gaps, and this occurs at the end of a price pattern and the signal beginning of a new trend. Exhaustion gaps occur near the end of a price pattern and signals a final attempt to hit new highs or lows. Common gaps cannot be placed in the price pattern. They simply represent an area where the price has gapped. And continuation gap, also known as runaway gap, occurs in the middle of a price pattern and signal a rush of buyers or sellers who share a common belief in the underlying stock's future direction. A result, the asset chart shows up a gap in the normal price pattern. And usually continuous gap is what you see most of the time. So here, for example, right, we had this stock and it missed earnings and it dropped drastically here. Like large institutions probably sold off, or whatever reason, people took profits. It sold off, but this is still a good company, right? Nothing fundamentally has changed. And you see here, it filled the gap exactly at the top again. So this would have been a good swing trade if you can buy the dip and then kind of like have like the gap as your goal to take profit.
Yeah, but what you missed there, Juan, if you go back to that chart, what you missed there is the horizontal trend line there, right? You
Yeah.
can sort of double paint that double bottom there on the other side.
Here
On the other
to
side
here.
of so on the other side of your red line that goes
Uh-huh.
diagonal. Yeah. So it tested that bottom again there and then shot back up. So yeah, it's definitely a good chart there.
Yeah, absolutely. Okay, so mid candle breakout. So mid candle breakout, sometimes you have like a stock, it spikes up, then it kind of pulls back, and it'll have an area here, and then it'll break out right here. So you have the middle candle breakout. You'll have the second day that it kind of just slows down. And then on the third day, if it breaks the previous day after a previous spike, some people enter here with the spike continuation. We'll give an example here. So we had this stock here. This is a daily chart. And on this day, it spiked up. It went from around $12 to $22, right? It was a major mover that day. And this, you catch these mid candle breakouts sometimes on these very volatile stocks that make a crazy big move on one day, like this right here. This is $12 all the way to $22. Then the second day, it kind of trends. It doesn't break out the previous day high, and it trends like just pretty not as crazy as before. So this day it went from $15 to $18. So if you have this on watch, some people on the third day, if they see these two candles like this, they'll take a position here at the break of the previous candle here. So the tip of this candle, if you see the wick, it stops here at 1811. That's where the entry will be here, 1811. And you see here it hit a high of 27.29. So this is sometimes like I mean, I trade it once in a while. It's hard to catch. It's hard to identify these and find them. But there's some people that just kind of like look for mid candle breakouts, and they don't come as often, I don't think, but they're, it's whatever you come. I just want to expose you to different types of trades. Do you guys ever trade mid candle breakouts?
Yeah, I really don't look for them.
Yeah. And
Yeah,
that's
so like there would be
Go
like
ahead.
a pre-market level, right? So on the 4 hour, you'd see that wick of the candle. So you'd be like, all right, that's the pre-market high. I'll zoom in on an intraday and I'll be like, okay, I'll wait for that candle to break up, close above, maybe even retest it as a support because it was a previous resistance. And after that, I'll take a position up to, the high hits. So yeah, good moves.
Okay, so dip buying, from what I know, most traders, that's really big, right? You want to buy the dip, and so you understanding the dip, understanding where previous support is, buying the dip is, I think, a big strategy for a good amount of traders. Most traders, they in some sort of fashion they buy the dip. Is that you, Penny Slayer, Malik? You guys buy dips
when they make sense, right?
when it
I
Yeah.
think that I'm not usually buying dips unless they're solid foundation and solid financials behind it. It really just depends, but I'm not usually buying dips unless they're like Microsoft or something like that.
But
Yeah,
in some point,
I'm not usually-
in some point of your day trade career, have you guys actually bought dips before and try to kind of find like a dead cat bounce or some sort of bounce scenario?
Oh, yeah, of course.
Yeah.
Absolutely.
Yeah, so
yeah.
what I would do is like I'd see the dip. It's not like I'd buy it as it dips, but I want a confirmation that shows me buyers are stronger than the sellers, and then I'll go ahead and I'll take a position.
Okay,
Right?
and JS, thank you for that. So buying the dip is like, let's say a stock spikes up, right? It spikes up, and let me pull up a chart here. And thank you for pointing that out, Jay. So this is let's see here. Let me get a daily chart here, a minute. Okay, so like, let's say JS and everyone, if I was looking at Palantir this day, right, and I said, okay, you know what, it's selling off. I'm gonna try to find the bottom and ride it to the top, or just catch it for a bounce. First, I would do like this trend line, right, because it's not breaking this. So you see here, like it drops, goes up a little bit, then it it tests this trend, drops, tests this trend, drop, tests this trend. And then over here, it breaks the trend, right? And then you kind of see this like long wick, skinny candle. Usually this type of candle, we talked about that candle last week, and this kind of sometimes symbolizes a reversal in trend. So we've had this stock, it was falling. Then you got this green candle, thin, kind of like a small body. And, you know, so that means the buying and the selling close was like really, really small, a little bit of indecision, maybe like some trend changing, right? So then here also on the stochastic, you have like an uptrend, and then it breaks this trend right here. So to me, you know, buying right here would be reasonable, and then holding, and then eventually, you know, it kind of went back up, right? So buying the dip is like as it sells off, you want to find an area where there was support. You want to find an area that makes sense, like it's breaking the trend, and you're buying the dip here, like you're buying here because it's sold off. And sometimes day traders that trade like penny stocks, sometimes those penny stocks, you know, they spike up quickly, and then there's an overreaction, there's fear, and they sell off quickly. So you want to buy it in an area where possibly it's going to find some support and reverse. So as it falls back down because of fear or whatever, you want to see where it's going to hold and where that trend is going to reverse, and then buying the dip. Sorry. So that's a dip buying. Dip buying is great for beginners. There's low risk, low reward. But you know, you have to kind of like understand the chart and know where support is. Look at past history pattern. Old resistance will become new support. Identify areas of support resistance. Understand also that there's natural support, like every 25 cents, every 50 cents, every 75 cents, every dollar mark, you know, usually acts as support, right? So if a stock is falling and it's trading at $3.40, for example, and you know there's some support at $3, and $3 is going to be a strong area to possibly buy support and see it reverse from there, because $3 is a whole number. It was support in the past. So stuff like that, you know, $1, $5, and $10 are all very strong support and resistance lines, just naturally, right? Any stock under $1, if you trade it, know that $1 is going to be strong resistance. A lot of those stocks that trade under $1, I don't trade that many stocks under $1, rarely. But if it does get close to $1, know that a lot of people take profit at $1 just naturally. And it usually, majority of the times, it won't break that $1. You know, a good amount of time, it won't break that $1. Indicators, previous highs, previous lows, 52 weeks highs, 52 weeks lows, previous opens and closes are all areas of support and resistance. Anything you guys add to that?
Yeah, I mean, I think that we talked about horizontal lines here a little while ago. Draw those horizontal lines and find the common denominator, right? Find when those bottoms are hitting this horizontal line, if you will, and you know, bring it back to a 30-minute chart, bring it back to an hour chart, bring it back to a daily chart, and just go and find those common denominators and find out where you are in the chart, because that's going to be important. It's going to be important for you to know for sure.
Absolutely.
Get yourself out of the 1 minute chart. That's the thing I think that we're trying to teach here. Get out of the 1 minute. I know you want to see it. I know it's more action there at the 1 minute, but you know, try to, you know, broaden your view a little bit more.
Yes, sir. So one common pattern that a lot of people know, a lot of traders are familiar with, is the bull flag pattern. I think everybody's heard of the bull flag pattern. So the bull flag pattern starts with a strong, almost vertical type of spike that takes the short sellers completely off guard as they cover in a frenzy. As more buyers come in off the fence, eventually the price breaks forms an orderly pullback where the highs and lows are literally parallel to each other, forming a tidal rectangle. So here we had the stock went from 1960, spiked up all the way to $21, then had this kind of pullback. Then the entry for me is I want to see the break of the previous candle. And like this green candle here. So we have kind of this flagpole. That's why they call it a flag. The bull flag number 1 trigger is a buy signal at the 2090 breakout. So I bought in here because it broke this previous candle. So like, for example, this red candle here, this second red candle didn't break the previous red candle. This third red candle didn't break its previous one. And then this small candle didn't break this one. But this green candle broke this one. So I would be comfortable entering here because I know if it doesn't work out, I'm going to do my stop loss below the low of this candle here. So it's kind of like I'm minimizing my risk. And then my first profit taking is the test of the previous high of this. So I may take partial profit here and then hold the rest to see if it can continue up. So this is how I play a bull flag pattern. This is very common. You see it quite a lot because a lot of times emotional traders and rookie traders, as soon as they see a stock spiking like this, they see it here and they all buy. And then when it doesn't continue to spike, they get scared and then they start selling off. And then the seasonal trader, they're waiting for this to form. Like, this can happen over 5 minutes, over a few minutes, but they're waiting for the pullback. So the rookie trader, they see the green, 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 and they jump in emotionally without a plan because they see a stock moving up. And then the seasonal calm player waits for a proper pullback, waits for an area to get in. They see some sort of good pattern that they're comfortable with. And they know their stop loss, which is the below of this candle. And they know when they're going to start taking some profit here, the break of this one. And then they know how to hold it. So that's how I play the bull flag. What about you guys?
Yeah, same way. A master of risk. I think that's what I take away from this, right? Is day traders over their span of time that they're in the market, they realize and harness being a master of risk. And that's the only thing that you can do, right? Because sometimes you get faked out in an opportunity that the market presents itself, and you get into a position and it doesn't work out the way you want. It doesn't necessarily mean that you drew your lines wrong or you read the charts wrong. It's just the way the stock market moves, right? So being a master of risk is the most important.
Absolutely.
For sure. And, when you're playing a bull flag, let's say the market isn't moving strong or the SPY is moving downward, right? If you were to take a position on a bull flag, it's not going to 100% going to run again, right? It might, not, and it might not hold the support level of that downwards trend that we call the flag pattern in the situation, right? So there's the pull, there's the flag, and then there's the pull again. So sometimes on a bad day, the market might not be able to hold that pull, and that's why we set stop losses. That's why we have the flag pattern drawn out, and when it doesn't hold or support, we take the exit. Probability is one of the most important things when it comes to the market. I have a high probability that this is going to do that, or a low probability that this is going to do that because of this and that. Like I say every week, guys, it's all about building that hypothesis, putting these little plugs together and seeing if the overall position is an entry or not.
Yeah, I mean, that's great, Malik, because I think that what people see sometimes, and probably what they don't understand, is whenever you see like if it's on Instagram or they're showing their trading station, they have all these screens that are up around their main trading screen. What you're really looking at is we're looking at the SPY, we're looking at the momentum of SPY, we're looking at the NASDAQ, we're looking at the S&P 500, and we're making sure that when we make our entries that all of those indices are in an upward direction, right?
Exactly.
Right. And so it makes a lot of sense to, make a position on this play if everything looks right, if everything is in an upward trend, because then it gives us the momentum that we need in order to make a position. So that's really what you're looking at.
Yeah, that was a great point to add. If you're jumping in this, think of the other that's going on, the other macro and everything that's going around you with making sure if all the indices are on an uptrend too, then this gives higher probability. Like Malik said, you're building a thesis, you're building a hypothesis. And if you see this bull flag and everything else is on an uptrend too, then you have a higher chance of being successful with your hypothesis. That was a great point, guys. So here are just a couple of other examples. Like sometimes a bull flag will form like this, where you have this kind of trend. And then sometimes like what we showed you the other example. And again, looking at the overall market, looking at the stock itself, if it's coming upon resistance and support. But you see here, it kind of like broke out. And here it broke out. But yeah, you want to make sure that everything is in your favor. You're looking at the overall market. The overall market's in an uptrend. The market is happy. It's in a good mood. There's some volume in this stock. You identify, you said, okay, I missed this spike up, but I see it pulling back. I'm going to jump in for the with the break of the previous candle, and I know what my stop loss is, and I'm going to hold because of the overall market's up and everything. So this would be a good kind of strategy. And here's another perfect kind of bull flag. A lot of times they're not going to be this clear, but you know, like you get the idea, right? You have this spike that you missed, and then you want to see the pullback. You see the pullback. You see the pullback here, and then on this candle, it broke here. It broke this area here. So you can jump in here, looking at the overall market. Everything else is green. Now, if you jump here, it doesn't work. I would get out the low of this candle here. This would be your stop loss. So you have a clear stop loss where you're preserving your wealth, but you have a plan and you have an idea of what you want. You want to see this breakout, which gives you more confidence to hold or take some profit and then hold, whatever your strategy is. I like areas that are going to be some sort of resistance or may have trouble breaking. I want to take some profit. So that way, if it falls, then at least, you know, when I jump out and break even on the other half, I'm still green from the initial one. So another pattern that some traders, day traders, or swing traders are familiar with is called the ABCD pattern. ABCD pattern, the only thing is it's pretty, for someone who's new, it's going to be extremely difficult to identify the ABCD pattern. But it is a pattern that's out there. I've traded it before. I actually have a live video of me identifying it early and trading it, and I recorded it as I was trading it. I found the pattern. I said, and I was kind of like recording myself. I don't know if I think I was trading live or not, but I know I recorded the trade, and I said, oh, this is forming an ABCD pattern. I'm jumping in here, and you know, this is going to be my profit target. So the pattern is characterized by an initial spike, which is here, during which the stock price reaches the high of day. The spike is followed by a healthy pullback as traders take their profit. B, at this point, we're looking for the stock to show enough strength by setting a higher low. So we have here, and then you want a higher low to kind of like give you confirmation that this is the B pattern. The higher low is, so this is the low here, spikes up, then it goes down. When it goes down here, the second part, this low here is higher than this previous low. So this is kind of like confirmation. Yeah, there's material attached below. So this gives you here confirmation that, okay, this is a higher low. This is good. So we have here A, spike up, higher low. This is the low here. It's higher than this low. This is the C. Then you'll see another little pullback. Then for me, I'll take some profit here as it breaks A, and then it continues. And, you know, when it breaks this A area, that's considered the D. So this is kind of like the ABCD pattern. It's, like I said, it is sometimes kind of tricky to find. But have you guys ever traded ABCD pattern?
Yeah, absolutely. Definitely.
For sure. So I will maybe make another video one day where I'll show like the live recordings and kind of give more material on it. So here's a good example. So we had this stock here, right? It spiked up here. So this is considered A, where it spiked up. Then it pulled back here. And then your confirmation that this is maybe starting to form the ABCD pattern is you see this low here, it spikes up a little bit. And then when it goes back down, it goes down, but it doesn't go as low as this previous. So this low here is higher than the previous low. That's what they mean when they're saying higher lows, right? So now here it spiked up here. And then the low of this, it went down. This low is higher than these lows down here. So this gives you more confidence. So I would like, if I saw this, you know, I would say, okay, let me jump in here. And if it doesn't work out, I know where to exit. My exit is this B area. Like if I decide to jump here because I see these higher lows, if it doesn't work out, I'll get out here with 30 cents, 40 cents loss, no problem. But then you just kind of hold it. You have the C area. And then here you want to see the break of this previous candle here. So when it breaks this, then that's the confidence. And you know, you're like in that ABCD pattern. And also like looking at volume, of course, you know, you want to make sure the volume matches with what you're saying. You want to see some sort of increased volume. And you see here, you know, a lot of people wait for this and they kind of like buy to make sure it's going to break. And that's even more confirmation. And it's a better strategy to buy it here. because you can kind of see the whole picture where you see the B, you see the higher low, it pulled back, and then it's about to break this A area. This is where you see these green little dots. This is where the stocks were purchased. And then you see the increase in volumes. So it's a good strategy that they got in here. It broke the A, tested it again, and it kind of continued, and they took profit up here. You guys have anything for ABCD patterns?
No, this is really good stuff for sure. No doubt.
So here, like even better, right? Like we talked about Malik nailed it on the head when he talked about you're building a hypothesis, right? Now you have, if you have something to add to your hypothesis that you're seeing an ABCD pattern, you have the intraday VWAP, right? That you're using intraday. So your VWAP's even giving you more confirmation, right? So you have here, this is the A, it spiked up to here. This is where it stopped. Then it pulled back here, and then it bounced on the VWAP on top of that. Now here, this is another low, and it's higher than the previous low, right? So here, some traders will get in here because it's above the VWAP. It's about to test this previous A area. So they'll jump in here because they saw this, that, hey, look, it formed a lot of higher lows. It's above the VWAP. This is pretty safe. It's above the VWAP. It's about to break A, and then you would be right, and you'll take your profit. And then you're looking at this and you're saying, you know what, but that's only a 50-cent profit. That's only a 70-cent profit. That's what we look for in day trader, man. Like if someone said, look, I'll give you a $10 profit 3 times a year, or every day I'll give you a 50-cent profit guarantee trade, I'll take the 50-cent profit guarantee trade every day. Because you're talking about jumping in like with 5,000 shares or whatever your thing is. 50 cents makes a big difference, and if you can do that consistently every day, then you're doing well.
Yeah, I mean, that you just said it right there. Compound your gains, right? And
yeah.
I think that a lot of traders out there are looking for the home run play, right? They're like, we're the $2, $3 a share, right? We need that type of play. But if you compound your gains, you're going to be in a lot better position. And I think that, you're right. I look for 50-cent moves, 70-cent moves all the time. I mean, I would love a move like that.
I always compare a good day trader to like I don't know if you remember Toni Polamalu, like the safety, like a good safety, right? Like they always say, like it seems like that safety, the good safeties like Polamalu, Ed Reed, like they're always in the right place, right? Like for some reason the ball bounces and they catch the interception, but it's not that. It's practice, and they're it's intentional a lot of times, right? So for us, like, having a good strategy and always being there and always, implementing that and being disciplined and taking base hits. Now, when the home run comes, a lot of times you're gonna catch a nice part of that home run because you're in the right place. You have a good plan, you have a good strategy. But if you do it the opposite, where you're just always looking for the home run and you don't hone in your skills and learn to be a good, consistent trader, then you're not going to catch those home runs a lot of times, or you may get lucky once or twice, but it's the long term. You want to be in this long term. You don't want to have just a major win and then a major loss, a major win and then a major loss, 2 major wins and then 5 major losses. I mean, that's not sustainable. You want to be able to do this for years and years and years.
Yeah, and also if you're going to catch a 50, 70-cent move, and if you're often good at that, you might as well trade options. So instead of dumping 10,000 in the trade to make $1,000, you could literally dump 1,000 in the trade to make $1,000,
Yes,
or not even. And that's kind of what I do mostly. I'm trading options because I'm catching those breakouts. I'm having the calls. I know you guys probably aren't, not you, but the people who are watching don't know much about options, but I'm making, $100 off every dollar move on the stock. So if it moves up 70 cents, I'm making $70. I buy 10 of those contracts. I just made $700, and I didn't need to buy 700 shares to make that money,
Yes, sir. And we do have an introduction to options class, hopefully coming within the next few weeks. But Malik is 100% right. I do that too sometimes. Especially the higher price stocks, I'll day trade them the same way I day trade, and I'll use options. But that's a great point, Malik.
Sure.
So understanding gaps to establish resistance and support, studying the daily chart, familiar with possible resistance, and we'll dive deeper in other patterns. But so the bottom line is understanding the chart, putting everything in your favor if you're going to do a day trade. You're following the trend. So the vertical and the horizontal, You're seeing that trend line going up, and it's also going to hit some sort of resistance, and volume is slowing down. Just kind of understanding overall, having a big picture, looking at everything when you get into your trade. Don't just kind of like guess, and especially don't get emotional. And if you see just a green spike, you want to jump in because you see a stock spiking up. If I've talked to so many traders, and the majority of the traders lose money because they see that spike, right? They see this spike here, and then they jump in. All this is happening because people are losing money or gaining money, right? This is everybody's happy, everybody's euphoric, everybody's buying, and then a lot of people bought here, and it didn't go. Now they're all rushing to sell. They're selling, and now here the smart guys that were kind of like laid back, looking at everybody. It's kind of like when Best Buy or whatever, like they have like the Apple sale, and the day before you see everybody kind of like getting online, sleep tent, and they all run and crash to Walmarts. And then maybe you have just a guy that just ordered it online. He's like, oh, I'll get it like a day later. But everybody else is like running, trampling over each other to get the $80 TV or whatever. This guy here just ordered it online and got it the next day. So, I'm I'm just laid back watching everybody trample each other. And then I'll say, okay, now that it's calmed down, the dust settle, I'm jumping in, I'm buying here, and I have an idea. I'm looking at a pattern, and I'm nice and calm. So
that's the first time I've ever heard stocks correlated to Black Friday.
Yeah.
That's great.
So that's just a few patterns, and there's many more patterns, but I just wanted to give you an introduction. And the most important thing, and we'll talk about it in trading psychology, is you have to just find what your comfort level is, right? What you're comfortable doing, right? Because maybe I see this so clearly, and I can identify these, and I love them, and I get happy when I see them. But maybe Penny Slayer says, you know what? I don't like it. It's hard to identify. I don't feel comfortable. And then his trading style, he says, oh, I love only pre-market breakouts. And I'm like, no, I don't like it. Like everybody has their own thing though, so you at the end of the day, you have to find what trading style works for you, what's your comfort level, and, and how you like trading, because you have to be able to do this long term. The goal is year in and year out, at the end of the year, to be green, to have an extra 40, 50, 60, 70, $80,000, whatever it is, of profits from trading. That's the goal, right? It's not to be red every year. I mean, then you need to stop. You have to reevaluate your trading style and find something that works for you.
Masters of risk. I love it.
That's it. Absolutely. And we're gonna start this one, and for like 15 minutes, and then hopefully the CPA will jump on. He told me he's gonna be in a good area for internet. So this one, level 1, placing orders and setting up a chart. So level 1 and level 2, it's kind of like it's extremely important, right? When we start talking about level 1 and level 2s, level 1 is kind of like this area here, right? You see this, it tells you what the bid price is, it tells you the high of the stock, tells you the low, it tells you what the stock closed at, it tells you how much volume. This is all good information, right? Level 2 is extremely important. I know for most day traders, they do look at level 2. It helps them along with everything else. It kind of gives them an idea if there's momentum in the stock, if there's a lot of resistance. Like if I see this right here, right, I'm gonna say, bro, 29.36. There's a lot of resistance. There's a lot of people selling at 29.36, right? So on this side here, these are the people selling, and these are the people buying, right? So if I'm thinking about jumping into this stock INTC, right? Right now, just looking at this level 2, would you buy Penny Slayer or Malik? Would you buy this stock at 29.36?
No.
Probably not. And, they would probably need a lot more information, but just quickly glancing at this, they probably wouldn't feel too comfortable jumping in at 29.36 because this guy's selling 1,000 shares at that price. This guy's selling 1,000 shares. This guy's selling 1,000 shares. This guy's selling 1,900 shares. This guy's selling 200 shares, 100 shares. So all these shares have to be bought. And of course, it depends on how much volume there is and all that. But just in general, right, you see all these shares selling at 29.36. Then more than likely 29.36 is going to be pretty strong resistance. So like all this stuff has to be sold for it to move, right? So level 2 gives you some good information that's important for day traders. Malik, do you use level 2 a lot when you're making decisions, or somewhat?
Yeah, I mean, level 2 kind of shows me where there's sellers stacked.
Yeah,
You know, there's
exactly.
like sellers all on this penny line and that penny line. But when I don't see those sellers, it's probably a better, a good time to take that position. Like I said, building the hypothesis of probability. This is just one more part of the hypothesis and probability that you want to add, is seeing if there's people ready to take, profits right at that high. So if you remember when we were talking about taking the position at the break of the high, before, right, taking it early, this is kind of going to help you in knowing if taking it early is a good idea or not, because if you see sellers stacked right at that level, you know that the price is going to get rejected and have a failed breakout. But if you see no sellers stacked, matter of fact, if you see buyers stacked at like a penny or two below, maybe things could kind of break out and kind of run.
Yeah. So like here, I would be nervous getting in here. But let's say this stock was falling, and let's say like Malik said, I want to build a hypothesis. I want to buy an area of support. So let's say at 29.30, I'm looking at a chart, and we're going to build some trend lines in a minute here for Palantir. Somebody requested, but like let's say 29. Let's say this is 29.30, right? And I'm building a hypothesis, and there was support here in the past at 29.30, and this is not 29.30, but I'm just giving you an example. So I'm saying, okay, look, there 29.30, there's previous support, and then I look at the level 2 and I see all these buyers here at 29.30. It's adding to my hypothesis. So 29.30, there was support. 29.30, it bounced and reversed there in the previous. There's an uptrend coming now, and I look at the level 2 and I see, bro, there's a lot of buyers here at 29.30. That would just build to my comfort level to think that 29.30 is going to hold, and it may be a good area of support to kind of like dip buy or reverse buy or whatever you're going to buy. And the same is true as the opposite. If I'm in a stock and it's coming upon resistance and it's slowing down, and then I see all these people ready to sell at 29.36, I may want to get out of that stock and take my profit, because this may not break. So that's just important to understand. It's just another tool you're going to have to add to build your hypothesis. You really, really want to have multiple things. And this is what, we keep saying this. I know we keep re-emphasizing this, but it's that important. You want to have multiple things in your favor before you jump in a trade. The trader that doesn't have longevity, they just get emotional. They jump when they see green movement up. They jump when they see just a little bit of price action, and they get them. And we all do it. I've been trading a long time, and I'll sometimes just get emotional and jump in. I'm not going to lie, but that can't be the majority of your trades. That could be that once in a while where you're just going with a gut instinct, but it's backed up with 5-10 years of trading, or maybe just emotional. You have that FOMO, you missed out and you make a mistake. That happens to all of us. But the majority, your discipline has to be that you have to have a plan. And if all those plans, all those things check off, like if you have 5 criteria, I said, look, I want to see an uptrend. I want to see level 2 good. I want to see breaking support. They check. Then, you can feel more comfortable jumping in a trade like that, as opposed to just one thing checking off and you're skipping all the other 4. So when you place an order, a good thing to do, you can practice with this ticker here, CVZZT. This allows you, if you have like an actual broker and you don't even have to have a paper trading, you can practice with this ticker. You can buy and sell this, and it's not real money, even if you have like your own broker. This is like a practice ticker on the stock market, where you can buy these stocks and you can sell them, and it doesn't count as cash. It's just a ticker made to practice. So this is good, like if you want to learn how to place a limit order, if you want to learn how to set a market order, whatever you want to do, you could practice with this ticker. That's extremely important. So chart setups, and this is going to vary from person to person. So some people, when they're day trading, they use the 1 minute, the 5 minute, and the daily. What do you guys use for your day trading charts?
I use the 1 minute, 5 minute. I switch between the hour and the 15 minute. but I obviously look at the daily just to see, outer levels, a broader aspect, a more general aspect of where price could reach. And then I start zooming in for the intraday trades.
Yeah, I agree with that. Yeah, I mean, if you ask me, my answer is going to be all of them.
All of them. Yeah,
I'm
absolutely.
looking at all of them.
Yeah. So then adding your indicators for intraday, I use VWAP. And adding your indicators is pretty easy. So like, let's say here we have Palantir. You go to indicators, and then you just type in kind of like whatever you want to use. If you want to use VWAP, it's right there. If you want to use moving averages, it's right there. Somebody asked about trend lines for Palantir. So Palantir obviously is it IPO last year. So for me, I would put one trend line here because it tapped it here, then it came down here. This is the monthly chart right now.
Yeah, I would look at the 30-minute chart. I mean, or the hour. That's going to give you probably some better lines that you can draw.
And then I'll go to.
I like to zoom in, to the from the monthly to the weekly to the daily to the 4 hour.
Yeah, so I'll go monthly, weekly, and then I like for me I like to change the colors, like so the weekly would be white.
That's huge. Yep.
And then the daily.
We can even draw a downtrend line from the high.
Yeah. Let's see. And then we could do, we can, the trend right now. So that's kind of like quick, like if I was drawing trend lines. Right now, you see it's bouncing off this monthly area here. So when it gets to here, it's either going to continue breaking down or it may break this trend. So this may be a good area for a potential swing trade. Right now, looking at Palantir, someone requested Palantir. If I'm watching,
listen, I made my entry at $10.59. I like this chart. I like it.
Yeah.
And so I made a position here.
Yeah, this is good right here. Look, you see it bounce off this maroon burgundy. This is the monthly. So if it continues to bounce, eventually here it's going to get to this tip, and it's going to hopefully break this trend here, and continue kind of go upwards. If it breaks
we
here,
break that green line and the purple line, that's two confirmations right there.
Yep.
Yeah. So yep. So that would be if you're going to swing trade. Getting in right now is good. It's a good entry. Penny Slayer seems to have gotten a good entry.
Tell you though, I didn't like something I saw on the monthly chart. If you want to go to the monthly, and I can show you what I meant. So what I seen is the 3 candles ago, the bounce it had off of like the $11-12 line was really strong, and then the next bounce it had was not as strong, and this bounce was really, really weak. So what this is telling me is that there's just automatic buyers, not active buyers, but people who set limit buys at that price level, that the first time it touched it filled a lot of them. The second time it touched it wasn't as aggressive. The third time was barely any sort of aggression. And each candle showing me that it's closing lower than the previous one, making wicks lower. So it's kind of worrying. I mean, I would have wanted to see active buyers be in the last 2 candles, just like they were 3 candles ago. But we do want to see and wait until that green line is broken just to give us further confirmation.
Yeah. So for sure, I would like to see this trend break, and that'll be a good sign. As you see here, look, it's still a lot of selling. I want to see some more green candles. I want to see this purple line, this purple trend break, if I was going to decide to kind of like swing trade it.
I'm not gonna lie. Sometimes I hear the people at the top of this trend really crying. They're like, "Oh, I'm in this at $27 and it's like near 10." I go, "Yeah, that's time to
There are
buy."
people in about $40, bro.
As soon as the pain really starts to hit, I mean, like that's the time you go, "Okay, this is getting more interesting now."
Yeah. So VWAP, what indicators do you guys use EMAs? Some people use the 200, some people use the 50, some people use the 13. What do you guys use?
I use the 9, 21, 50, and 180.
9, 21, 50, and 180. Okay, cool.
So I'm a little bit of a purist when it comes to this. So I'm 20, 50, and 200. And I know like that's not really what a day trader uses. But what I like to think is that the more people that use a specific indicator, the stronger the indicator becomes, right? And so I tend to flex around those 50, 20, and 200 a lot, just because I think that more people are using that specific indicator more than any other one.
Got
But I do give myself some flux in those EMAs also.
Okay, so let me type it for the chat. So Malik, you said you used the 9, 20, and 180 EMA or SMA?
9, 21, and 180. Yeah.
EMA or
And when
SMA?
the 9 EMA, 21 EMA, 180 SMA. So I use 9 and 21 for entries, exits when I'm like in a scalp that's running really, really, hard. And then I use the 50 to see if there's a sort of pullback. And if I see the 50 broken, I usually see a pullback to the 180 line. And if I see the 180 broken as a golden cross, then I'll probably see it come to the 50. And that's where, we'll see decision happen, just like VWAP, of where the stock wants to be above or below for the day. And if it's above, we kind of anticipate calls.
And you said Penny Slayer used what?
The 20, the 50, and the 200.
EMAs?
Yep.
Okay. So they're the one that Malik. Oh, you said you also use the 50, right, Malik? Or
Yeah,
no?
I use the 50 as well.
Okay. So it's this one and the 50. So they both use the 50. They both use something close to the 20, and they both use something close to the 200. And we got my man Penny Slayer here. Hold on one second. Hey.
Hey, can you hear me?
Yes, sir. You sound good.
Yes, I love it. You sound good
all right.
too. How are you?
All right. Good. I'm doing well. So just to give you an idea what we've been doing here every Saturday. You know, a lot of the gurus online, they sell day trading courses for $5,000, $4,000, $3,000, $3,000. They promise that they're going to get you rich overnight. Yeah. Well, I put together a team that has proven track record of day trading. I've been day trading for 10 years. Malik is a millionaire day trader. Penny Slayer's got a great Discord. Malik's got a great Discord. They're all proven day traders. And I put together a course and I'm offering it for free, for the day traders.
Okay.
Yeah, just to get back. But, just to give you a background, I day trade, I swing trade, but I went back to school to become a financial analyst. And, so I also do due diligence on stocks. And I love the stock market, man. And I've been watching you on Instagram. You have some great interviews. And that's the reason I really, really wanted to have you on, because you do these interviews and they bring such benefit to people. I mean, like I seen that guy that talk about the housing market stuff.
Yeah.
And I seen you had a day trader guy. So it's like, I love collaborating with people that have like great information that they offer for free. I think that's so important to give back. So thank you, man.
I love it.
If you can give, that's kind of like a little introduction. If you kind of give an introduction about you, I know you're a certified CPA and what you do, and introduce yourself, man.
Yeah, thank you so much, Juan, for that little brief introduction there. My name is Stephen Gabrielson. I'm a CPA. I am based out of Boise, Idaho. I do run a virtual CPA firm, an accounting firm. We specialize in tax. My strength and my specialty specifically is real estate. I do a ton in the real estate game around tax strategies and stuff like that. A lot of the type of people who we work with, there's the page right there. So a lot of the type of people that we work with are people who make a lot of money and are looking for ways to reduce their tax liability. So we work with a lot of day traders, a lot people who have made a lot of money really quickly in the crypto game. And we teach them how to take that money that they earn and reinvest it in other assets that can actually generate tax losses and reduce their overall tax liability while increasing their long-term wealth and their monthly income. So that's really where my specialty and my focus is. So hopefully during this conversation here, I'll be able to bring some stuff to the table and help you guys out.
Yeah, man. I'm excited, and everybody, this is going to be recorded. So make sure, if watch it, keep it. I have some questions, and I think some of the guys here may have questions. And if anybody has questions, you can just shoot it. So my first question, as a day trader, right? You're buying stocks, you're selling them the same day. So there's major tax implications. I mean, if you make over 400,000 a year, you're getting taxed above 40-something%, right? So is it better to day trade as like an S corp or an LLC, or is it just like an individual? Like what would you recommend the day trader to like, what should they do? Should they take an S corp or LLC or just individual?
That's a great question. And so the first thing I want to do is define day trader, right? Because the IRS actually has legitimate rules around who a day trader is and what qualifies you as a day trader, right? If you have a full-time job and you trade stocks every other day and you're kind of doing it off and on, you're probably not actually qualified or classified as a day trader within the eyes of the IRS, right? The IRS is very strict on who they classify as an actual day trader because there's a lot of tax benefits that come from day trading. And one of the main benefits, as I'm sure you guys are aware, is actually being able to take expenses against the income that you're generating from that day trading activity. And so when you actually cross that threshold into becoming a day trader, and there's a ton of different information out there as far as who qualifies and who doesn't qualify as a day trader, usually it comes down to volume and intent. If you're showing that you're trading very regularly every single day from stock market open to stock market close, and it's basically all you do throughout your days, most likely you're going to be considered a day trader. Then at that point, you're actually able to take that income and offset it with by expenses that you purchase, like computers, softwares, different types of business generating activities and expenses that you have. You can actually offset the income that you're generating from your day trading activities. That type of income is best to run through an actual S corporation because what it does is it reduces your overall self-employment taxes. Now the big thing about where people are going to get trapped, right, is as they leave their W-2 jobs and get into the day trading world, what you've done at that point is you've basically built a business around your day job, right? You own your job, and because you own your job, the IRS requires you to pay both halves of those payroll taxes. Because when you're an employee and you're earning a paycheck every single day, the Social Security taxes and Medicare taxes are about 7.5% of your paycheck. They get taken out every single paycheck, right? But what you don't see as an employee is the employer actually matches that 7.5% and pays a full 15 to 16% to the government, either on a monthly, quarterly, or weekly basis, depending on how big their payroll is, right? And so when you then become a day trader and you leave your job and you own your job, you're considered a self-employed individual. And as a self-employed individual, when you report your income on your personal tax return on a Schedule C, the IRS actually makes you pay both halves of that based on the net income of that activity. So if you make $100,000 day trading and that's your net income, the IRS is going to tack on an extra $15,000 to $16,000 of tax on top of your ordinary income tax rates. And so that's why, if you're familiar with Robert Kiyosaki's cash flow quadrants, you have the employee in the top. This is opposite. So if you have the employee in the top left, I'm thinking if I got top employee top left, self-employed bottom left, right? Then you have the business owner in the top right, and then you have the investor in the bottom right. And if you actually apply tax rates to that quadrant, the employee typically pays anywhere from 30 to 40% in taxes. Self-employed individual is anywhere from 40 to 60% in taxes because they're paying both halves of that self-employment tax. Then your business owner is about 20 to 25% taxes. And then your investor is usually zero if they're doing it right. And so what we do when we actually set up a client on an S corporation is we're taking you from that self-employed bucket and we're rolling you into that business owner bucket to reduce your overall tax liability so that you're not paying both halves of that self-employment tax. So a lot of stuff to consider. I kind of shot you with a fire hose there. I'm sorry.
I love it. I love it. Okay, so
Awesome.
what about we hear this a lot. We hear about the wash rule. Can you kind of break down what the wash rule is? Just kind of explain it in a way that's easy to understand.
Yeah, heck yeah. So the wash rule is my favorite thing right now in crypto. And we're only going to have it for who knows how much longer. No one really knows how much longer we're
Well,
going to have it.
they haven't voted against it yet, right?
Exactly. They haven't voted. So it's
Yeah.
in the Build Back Better
Yeah, it
plan or
is.
whatever
Yeah.
the hell they're calling it. So they change the names of these bills every freaking day. No, it's so hard to keep up with. But so Build Back Better, it keeps stalling out in Congress. And within the Build Back Better rule, they're talking about getting rid of the wash sale rules for crypto. Or sorry, applying the wash sale rules to crypto. So what the
Right.
wash sale rules are is if you're day trading the stock market, for example, right, outside of crypto, that it is looked at as a security, right? Where crypto is actually looked at as a product. It's not looked at as an actual security. And so securities are limited to these wash rules or wash sale rules. And so what that means is, let's say Apple is trading at $100. I know it's way higher right now, but let's say you buy Apple at $100, it drops to $50, and you know it's going to go back up to 300. So you sell it to harvest the loss, and then you rebuy it immediately at that $50, and it takes off, right? That's called a wash sale. So the IRS actually requires you to sell it and then wait 30 days to rebuy it in order to be able to take the loss from that asset or from that security. Okay. Now, where crypto is special is it's looked at as actually like a product or an inventory, and it's not looked at as a security. So the wash sale rules do not apply to crypto. So if you buy Bitcoin at 46,000 and it drops to 38,000, and you sell everything and you rebuy it immediately, and then it goes all the way up to 50, you're able to take that loss that you just generated from buying it at 46 and then selling it at that 38 level. That loss that was generated right there, you're able to take that on your taxes, even though it spiked all right back up to 50 grand. Right. So that's called tax loss harvesting. And it's a really great benefit of crypto right now. Now, again, we don't know how much longer we're going to have that. If we could lose that ability next week, they could potentially go in and make it retroactive back to the beginning of the year. There's a lot of stuff and a lot of possibilities that can come to play with that crypto wash rule. So we get the benefit for now, but who knows how long we get it.
Okay, so just to recap then, so let's say we have stock XYZ trading at 1,000. I have 10 shares. Okay, so that's 10,000. It drops to 90 and I sell it. Oh, I mean, I'm sorry. It drops to 900 and I sell it. And then you have to wait 30 days, right?
Yep.
So I wait 30 days, rebuy it at 900, and now it goes up to 1,200. That loss that I took from 1,000 to 900, I can claim that on my taxes, even though I made it back after I brought it at 900 and made 300 on it.
Exactly. Yep. It's exactly right.
And the wash rule, obviously, for the day traders, it doesn't apply to us because we're buying it, we're selling it and buying it, within the same day. We're not waiting 31 days, right?
Right, exactly. So when you're sitting there and when you're doing the day trading, you're buying and selling constantly, right? So exactly, it doesn't necessarily apply to you guys because it's more of an active business. It's completely different. You're looking at it as a trade of business, not something that you're doing with capital gains and losses.
Okay. So what is how does crypto get classified again as tax when you're getting taxed? Like what do they classify crypto as?
So they classify crypto as an actual asset. It's not looked at as a security, right? When you're doing stocks and bonds and stuff like that, those are actual securities that you're buying and selling that have different rules than like purchasing and selling regular assets, right? And so crypto is looked at more of like an asset rather than a security, which is why the wash sale rules don't apply to it.
All right, look, we got if you buy back from a different broker, it's very difficult for the IRS to find out. Is that is that true, or how's that work? Like, let's say I have TD Ameritrade, and that's one broker, and then I have Robinhood on another broker. So on the TD Ameritrade, I had 1,000 shares of Tesla, and it dropped $100. So I sold, and then I guess transfer that money to Robinhood. And then buy it back in Robinhood. I mean, like, I guess that's what he means. Like, what is?
Yeah,
is that what
I'm thinking that's what it means. But the thing is, so yeah, I would think it'd be difficult to track. So I mean, theoretically, maybe you can get around it because it's not within the same brokerage, right? And so then you wouldn't be having the shift back and forth, or it wouldn't come through on that brokerage statement as a wash sale. Right?
I guess he means like I don't know. I don't really understand, because if you buy it with a different broker, what's the benefit? Like, is he trying to buy it before 30 days and then claim it?
Yeah. So I think what he's saying is, so when you do it within the same brokerage, right, you're selling it, and that brokerage gives you the brokerage statement at the end of the year, your 1099, that breaks out what you sold and what you purchased and what the wash sale rule is. So when you get that 1099 from your brokerage at the end of the year, they usually have disallowed losses, which is your wash sale losses, right? And so if you were to sell it and then transfer it to a new brokerage, theoretically you're getting around that rule, because that brokerage that's going to be giving you that 1099 at the end of the year doesn't know that you then transferred it to a different brokerage and rebought that stock. And so theoretically, I would think that would work. Honestly, I don't play enough in the stock game, the stock market game, to know how that's going to be reflected on 1099s and stuff like that. But it's sketchy. It's sketchy to say the least.
It sounds sketchy for sure.
Yeah, I mean, theoretically, you can do anything that's not reported on a 1099. Then if you get audited, you're going to get slapped around. But
I had a day trader once. He was kind of like upset because he had like major losses for the year. And you know, I don't remember the exact numbers, right? But let's say he had like a $20,000 loss for the year. And then when he went to claim it, he was only able to claim $2,000 or $3,000. What's the limit that a day trader can claim at the end of the year, like no matter what?
Oh, dude, that's a good question. Because the thing is, when so you're saying he had those losses and they were capital losses, so he's only able to claim $3,000 on his tax return.
Yeah, so like he had like a $20,000 at the end of the year loss, but the way the tax law is written for day trading, he can only claim a certain amount of that, which was like it ended up being $2,000 to $3,000 or $4,000. I forgot what it was.
Yeah.
Oh, it's because he's trading on an individual account instead of a business account. So
that's exactly right. Yeah. So if you're looking at it as capital gain, and remember, when you transfer to a day trader, it's not even necessarily looking at it as capital gains and losses anymore. You're active business and active losses, and it's all from an active standpoint. It's not even capital gains and losses at that point when you're a day trader, right? Because it's a full trader business. If you're just doing it on a personal level and you're trading here and there, it's capital gains and capital losses. Capital losses, if you drop your account into a capital loss for the year, you are limited on what you can take from a capital loss standpoint, right? And we talk a lot about this on the real estate side because we're dealing with three kinds of income here. We have active income, which as a day trader, your income's an active income, right? If you're just doing regular trading here and there and you're not an active day trader, you're dealing with capital gains and losses. When you have a capital loss, your capital loss can only offset capital gains. You're limited to $3,000 a year in capital losses to offset your other income from your active income category. And we deal with the same issue with real estate, right? Real estate's a passive activity. And so if you have a real estate that's dropped into a loss, right, that real estate loss is a passive loss and it can only offset passive income. Unless you meet certain rules and guidelines that then allow you to take it over to offset active income. And so it sounds like he's being treated as just a regular Joe Schmo buying and selling stocks, not an actual day trader. But again, I'm not super familiar, or this area of the tax law isn't my expertise. But that's what it sounds like. It sounds like he's treating himself as a person just selling randomly, and he's limiting himself to that $3,000. So if he is an active day trader, honestly, he should probably go back and amend that tax return and treat himself differently.
Excellent. And what about with NFTs? Are NFTs considered like defined as a collectible?
Man, that's a great question. And it's looked at, and the NFTs are so new within the tax world, right?
Yeah.
We're kind of breaking ground on a whole new territory when it comes to NFTs, which is pretty freaking cool in my opinion. So when we're working with NFTs and stuff like that, how we've been handling it with our clients is if we're working with someone who's developing and minting these NFTs, we basically treat it as a regular business if they're doing it regularly, right? We set up an LLC around the wallet, and then we actually have take the expenses that go into generating those NFTs, and anytime they start selling the NFT on the market or whatever you call it, then they have income that's being generated from those NFTs. And so from a collectible standpoint, because you're talking about a collectible, right? As if it's
right, because if it's considered a collectible, then there'll be like a 28% long-term capital gain tax, wouldn't there be?
Yes, I believe so. And again, I'm not super familiar on the collectible side of things, but it is treated a little bit differently, and they have more beneficial tax rates on it. So as far as NFT goes, I haven't heard anything that specifically sets them up as being a collectible. But again, you're talking about something that's pretty freaking new within the tax code. And so a lot of these things, especially even within crypto, which is a lot of reason why you see the wash sale rules within crypto, right? The IRS wasn't even expecting people to start leveraging cryptocurrencies as a way to generate tax losses to then offset a lot of other income. So yeah, a lot of this it's going to be changing, and there's a lot of what we call a quote unquote gray area within the crypto space and that world. So yeah, a lot of ways to look at it.
We got a comment here. It says you have to apply to IRS before April 15th to get a day trader / business status to get the full benefit of taking expenses as a business. Is that accurate?
So I would think what you're saying is you have to, when you file your tax return, you actually mark yourself on that tax return as a day trader, right? And so I'm thinking that's what you're saying. I don't believe there's a full separate application for it. It's just basically how you're setting up the business. Again, I could be wrong. I don't deal with a lot of active day traders. So I don't believe there's a separate form, but on that tax return, you actually do mark yourself as an active day trader if you are one.
Cool. Can you break down what exactly is tax law harvesting?
Tax loss harvesting. Is that right?
I'm sorry. Tax loss harvesting. I'm sorry. Yes.
Yeah. So tax loss harvesting is a lot like we were talking about with the wash sale rules with crypto, how they're not applicable to cryptocurrencies, right? When you have an asset that drops in value and you can sell it and buy it back immediately, that's called tax loss harvesting, right? Where you have these assets, you know you're going to be in the stock market for the long haul. End of the year comes, you sell a lot of things that are quote unquote bad assets. Take that money, reinvest it into better assets, right? You're harvesting those losses to offset other gains and stuff like that, right? So if you have a year where your good investments do really, really well, and you have a lot of gains, and you're probably going to have a lot of gains to report on your tax return. It's also a good year to then turn around and look at some other assets that you might not be using or might not keep long term. And if they're in a loss territory, it might be a great year to sell those assets to harvest the losses from them to then offset those gains.
Okay. So
does that make sense?
So let's say I'll break it down. Let's say if you have a portfolio of 10 stocks, right? And let's say 7 of those stocks at the end of the year made you $100,000 in profit, right? You're green, you're up. Your other 3 stocks, you're down $40,000 on them. It's better to sell those stocks, wait 31 days, rebuy some stocks if you want or whatever. But that $40,000 is going to give you a tax saving on your $100,000 that you've gained.
Exactly. Okay. And so if they're just dogs, like let's just say you made bad investments, right? And they're just dogs, and they dropped in half right after you bought them, and you know they're not going to go back up. And so that's a great situation where you would sell them, harvest those losses from them, either take the proceeds from the sale and invest them in a different stock or a different one that's doing better, or you can, like you said, wait 31 days and then rebuy that same stock, hoping that it goes back up.
Okay, then what is the highest in, first out accounting method?
Yeah, so highest in, first out. So there's a lot of different accounting methods, and this goes into this is a great way to look at actually crypto, right? And why we look at it differently from a security standpoint, because remember, crypto is not securities, right? Crypto is more of a product or an asset. And when we track inventory, for example, from an accounting standpoint, we look at there's different types of inventories that you deal with, right? Like for example, if you're dealing with a general typical product, right? You typically you would do first in, first out method, meaning it's the first in the warehouse. And when I make a sale, that's the first product that's going to leave the warehouse to go to the customer, right? Rice is a good example of first in, last out, right? Because you pile the rice in one big pile, and then you typically take the rice off the top to go take it to the consumer, right? So that's first in, right? The first in is the rice on the bottom that's going to sit there for a while. And then if you take it from the top, then that's last out. It's going to be the last one out of the warehouse. So there's a lot of different ways to account for different accounting methods. Crypto is really cool because we have the ability to do high in, first out, meaning if we're buying a bunch of cryptocurrencies and we start high, right? And when we sell those assets, we're going to take that highest cost basis off first. Does that make sense? So if we sell a cryptocurrency, instead of trying to find a moving weighted average, or this is the crypto, I'm selling this crypto when I bought it at 46, now I'm selling it at 58. Instead of doing that, we can just basically say, when I was buying this crypto, I bought it anywhere from the range of 30,000 all the way up to 60,000, right? And so then when I sell at 50,000, I'm going to say that I just sold my original stock that I bought at 60,000. So you're able to take a little bit of a loss there.
Got
Does
it.
that make
Got it. So
sense?
yeah. So let me see if I break it down. So let's say I bought whatever at XYZ at $10. Okay.
Mhm.
And I bought a bunch of shares at $10. It drops to 8 and I buy some more, right? So I'm averaged in at around $9, right? You know, like if you
Mhm.
average it in, and I sell some at 9.50, right? Which is still
Yeah.
green because you averaged in. But when you get taxed out, the way they do the taxes, you can still claim a little loss because the first ones that you bought were at $10 and now you're selling it at
Exactly.
9.70, right?
Exactly. Exactly right. Exactly right.
All right. So I've asked quite a few questions. I got a panel here of guys. If you guys have any tax questions, Snapback CPA is killing it. I love it. You know, he's breaking it down in a
I
way that
appreciate
is easy for us to understand, you know, which is extremely important, right? Because this is not our field. I can read a text about wash rule. I can read a text about all these different things. And sometimes just to break it down, like, you know, the way you're breaking it down helps tremendously.
Oh, I
So
appreciate that. And the thing is, again, this isn't my niche within the tax code. I wish it was for this conversation because there is so many moving pieces and parts. And like I said, the crypto space, man, there's so much gray area in the crypto space. No one really knows what the IRS has no idea what they're even doing within the crypto space. And so it's kind of up to us to interpret how we should be doing it based on how these different types of investments are classified. So yeah, a lot of fun.
absolutely.
So, Steven, I have a question. So you have a team of people that help individuals come to you for business opportunities, or they're trying to have their taxes worked on. You help them through that, because at the moment I'm currently looking for a tax guy. So
I love it. I love it.
I do stocks and cryptos in order to fund my housing unit stuff that I do.
Mhm.
And so when I buy homes or flip homes or buy rental properties and things like that, I need someone that's geared into knowing the financials of that, and recently have gotten into it. And so I need a good test guy. So it'd be great to connect and see if we can't get somebody on your team to help us out a little bit.
Absolutely, absolutely. We'd love to help you. And this is really the realm of what we really do, right? We're a lot different than normal tax firms. And the reason we're a lot different is because all that we do is forward looking, right? Most tax firms are bring me your stuff at the beginning of the year and we'll look backwards and we'll look at everything that happened last year and we'll file your tax return accurately. Where we're different is we actually try to work with you as much as possible throughout the year. We have a lot of different tools available to you throughout the year as you work with us. A big thing that we do is we actually have a quarterly call, right? So me and my senior tax manager actually we're starting this brand new this year, but every single quarter, we're going to do a live call with all of our paying clients. So if you pay us to do anything, right, you get access to our quarterly call. And so what our quarterly call is, we go over a tax strategy topic and then we field Q&A. So it's just a way for us to get in touch with you guys throughout the year, try to figure out where your guys' heads are. But I have a full tax team who handles the tax preparation. And what I love about it is it gives me the opportunity to do stuff like this in the middle of tax season and work with people and get out and talk to people and teach people about stuff. And then I have my staff who is really good, who I get the ability to train and build up and learn to look at the taxes, how I look at taxes. I have the ability to train them and teach them so that we're all on the same page. So that when we get people like you guys.
That you were here today. I mean, I figured that you would be crunching numbers at the moment. Like,
Nah,
I
dude,
got so much going on.
Yeah, not at all. This is my zone of genius, is getting out here and talking with people and teaching people. This is really my zone of genius. If I were to sit down, there's nothing that I am not built to sit behind a desk and crunch out tax returns. I've spent my time doing it. And it's not where my zone of genius is. So this is really where I'm strong and can really provide a lot of benefit, I feel. But yeah, for sure.
And we have another question from the crowd. So we touched on this about getting an S corp, but why an S corp versus an LLC?
I love this question. I get this question probably every single day on all my social media platforms. The thing that you got to understand and know is that an LLC does not change your tax status. The LLC is a limited liability company. And I love LLCs. Whenever you have any income generating activity, I always say do an LLC. Don't file an S corp, get an LLC. The reason LLCs are awesome is because they don't change your tax status, but they add a massive amount of flexibility from the tax side, right? Because when you're an LLC, it's the wild, wild west, the tax code. We can take that LLC and we can elect to have it filed as a single member LLC or a sole proprietor on your individual tax return, which would be subject to self-employment taxes under certain circumstances. We can elect to have it filed as an S corporation, a C corporation, or a partnership. We can literally take that LLC and file it in any way that we want to. So if you come to me in April and you made $100,000 and you had no business structure, there's nothing I can do for you. But if you have an LLC and you come to me in April and that LLC was set up last year, I can roll all that income underneath that LLC and elect a late filing election for that S corporation, file you as an S corporation, and reduce your self-employment taxes. And just so you guys know, if you do like $100,000 through an LLC and you do not file it as an S corporation, you file it as a single member LLC or a sole proprietor, and it's subject to self-employment taxes, you're going to be overpaying by about $10,000 on your taxes, just on the federal level. Okay. So when we pull you to an S corporation, we're saving you 10 grand right off the top. Just an easy transition that a lot of people miss. So every single time that you have an income generating activity, put an LLC around it. Please don't elect S corporation or anything like that, because there's a lot of income generating activities like real estate, for example, that you do not want in an S corporation or a C corporation. But with typical income generating activities like day trading or like a small business or anything like that, put it in an LLC.
So is S corp better? Like, I guess if you have like a lot of employees or something.
So even then, right, it all depends on the net income of the business, right?
Okay.
If your business, so typically there's extra expenses that go to running an S corporation, right? You have to put yourself on payroll. You have to get a reasonable compensation from the corporation. You need to make sure that you're tracking the business. So you have a bookkeeper. It's a separate tax return. We actually put it on an 1120S tax return. So all in all, you're probably looking at $5,000 more expenses throughout the year. And so the reason we say when you have a net income of $40,000 or more, that's when it makes sense to transfer to an S corporation, because that's when the benefit of the tax savings actually outweighs the extra cost of all those items throughout the year. Because at $40,000 of net income, you're looking at roughly about a $5,000 tax savings. And so at that point, the benefit outweighs the cost, and you want to make that transition. But before then, if you're just running like a small side business and you're generating $20,000, $30,000 worth of income, put it in an LLC so you have the flexibility. But it doesn't necessarily mean drop it into an S corporation quite yet.
Got it.
Yo, so what would be the best way to form that LLC? Like the easiest and
Hey, Snapback. I'm sorry, just to introduce, that's Sean from We Are Investing. He's got a YouTube channel too. He's a swing trader. He's an engineer by career. Great YouTuber, great information. His channel has got great information on investing and stuff. Just wanted to quickly introduce him, man.
yeah, I'm glad to be here.
Great question, Sean.
Yeah, we tried to connect last week,
great.
but I guess the brewery you're at had bad signal or something.
I know. Geez, my bad, you guys. I'm sorry about that.
No.
So that was funny. So LLCs, dude, the best place to file that LLC is inkfile.com. I love inkfile.com. I don't get paid by them, so I'm just saying. But inkfile.com is super freaking easy.
Yeah, they do everything. They set up bank accounts and all that stuff. It's all part of the process. That's who I use to create mine.
Have you heard of Incorporate Fast or no?
I haven't. There's a lot of softwares out there that'll do it for you, and most of them are pretty damn good. A lot of them overcharge though, so you want to be careful because a lot of them do overcharge. The reason I like Inkfile is because they're super user friendly, right? The website is super clean. It's super easy to understand. And I mean, it's just really easy, and it's not super expensive, right?
If you the state you live in, or do you pick like, so I know like some companies, like they love Delaware.
Yeah, great question. So Delaware is great for corporations, right? Delaware doesn't have a ton of benefit for LLCs. Whenever you have an income generating activity, and this goes back to what we were talking about at first. When you are actually, if you have a small business, right? We'll call it I don't know, what do you guys, a plumber? We'll just say you're a plumber, right? If you're a plumber and you have an and you need to file an LLC, let's say you're in Idaho, okay? When you're in Idaho, you want an Idaho LLC for that activity because you are conducting that activity in Idaho. right? If you were to do a Delaware corporation, you would have to do a foreign filing in the state of Idaho. So you'd have 2 filings. And that's at the corporation level. Delaware is really good for corporations because you can control, if you were to get in a lawsuit or anything like that, you're able to control who or where that lawsuit takes place, and you have a lot more control over the process. Whereas when you're an LLC, you want to make sure that you file the LLC within the state you're doing the activity, because that protection from the state laws, right? LLCs are very state specific, and every single state has different rules and different laws and different protections. And so you want to make sure that you file it within the state that you're in. Again, I'm not an attorney, so this isn't legal advice by any means.
Yeah.
But for example, if we have assets that we're purchasing, like real estate, for example, we do real estate holding companies. So we actually have a real estate holding company that we choose to file in Wyoming that then owns subsidiary LLCs that own the properties in different states where those properties are located, right? So let's say you have a rental property in Florida, one in Texas, and those are the 2 states that you have. What we would do is we would open up a Wyoming LLC that you own between you and your spouse or you and another entity, so that it's a partnership. And the reason we choose Wyoming is because it's a non-disclosure state. So you can't look on the Secretary of State website and figure out who owns that LLC, right? Mm-hmm. So if you were to come under a lawsuit, they don't know if they're suing freaking Jeff Bezos or just some random Joe Schmo off the street, right? They don't know who you are. They don't know how deep your pockets are. And so there's a lot of benefit to that by filing in Wyoming. And then that Wyoming holding company owns 100% of the subsidiaries in the different states. And so there's a lot of asset protection that comes from that. But as far as filing within different states, if you are actively involved in that business, meaning your blood, sweat, and tears are going into that activity, you have to file that LLC within the state that you're operating in order to get the liability protection.
Okay, cool.
Okay.
Are there any major delays this year because of like the COVID taxes and all that stuff, or everything's going to be normal this year?
Don't even get me started, man. The IRS is still not answering phone calls. I tried to call them 3 times yesterday and I got hung up on 3 separate times. And even that's the thing, dude, like even for tax professionals, right? We have what they call a tax priority hotline. And yeah, they still hang up on us. They don't even, and we're still sitting in a queue for 3 hours. And the thing that pisses me off the most is we'll literally sit in a queue for 2 hours waiting on hold. And they'll say, you're third in line or whatever. And then after 2 hours, they just hang up on you.
Oh, man.
And you got to start all over again. And so they have publicly come out and announced that they're still way behind on 2020, processing 2020 returns. They announced as of January of this year, January 2022, they had finally finished processing all tax returns that were filed by April 15th without any errors or complications, which is probably about 80% of the returns, or not 80% of returns that were entirely filed, but there's still a massive amount of returns from 2020 that still haven't even been processed yet. So I think it's very realistic to expect another year of massive delays within the processing. And honestly, I think this is the new normal. I don't think the IRS is ever really going to be, I think it's going to be 5 to 10 years before the IRS can come back from this. We're still seeing massive delays on responses to IRS notices. We respond to a notice, they make you respond via snail mail. And so you send in a response and we're 6 months plus before we even get acknowledgement that we sent them a letter. So they're significantly behind. So the best advice that we're giving out this year is try to file early, try to file accurately. And it's super hard to do that just because as we've been going through the tax seasons over the last 2 years, we get massive tax change in the middle of tax season. And so it's really hard to even file an accurate tax return anymore just because things are changing every single day. And so just expect delays. Do not rely on your tax refund in order to fund your trip that you already booked, right? Don't rely on it. It's going to be a bit till you see those refunds most likely. So just some food for thought there, but yes, expect some delays.
Excellent. Got any more questions from the panel here?
I got a question real quick. So I just started a 529 plan for my daughter for college savings. Uh-huh. She's super young, but I got questions like outside of that. That's great for education purposes in college and whatever. What's another awesome investment vehicle that I can like start for her? I was looking like in the Roth IRA, and it's like it has to be earned income, and she's 1.5 years old. She's not earning any income.
Okay.
But like,
So let
what
me
are
ask
some
you this,
other
dude. Let me
options?
ask you. You are a day trader, right, or swing trader?
I'm a swing trader, civil engineer by trade. That's what I do for a living. So
Sweet.
yeah.
Sweet. So do you have so are you looked at as like an active day trader?
No, I'm not. I don't. That's not something I don't even know like what requirements that's needed to be an active day trader as for tax purposes.
Okay. Yeah, it's basically just based on volume mostly. But so ways that you want to get around that is the best vehicle. So there's a lot of vehicles state-wise. Like you can get into like 529 plans, and there's other little types of vehicles that you can get in within your individual states. There's good bank accounts that you can get them associated with and start building interest and stuff like that. What we love to do with a lot of our clients, if you're a small business owner or if you have a real estate portfolio or anything like that, we like to push you guys into those types of investments so then you can start getting your kids involved, right? As soon as you can get your kids involved in your small business or your real estate properties or anything like that and have them actually start doing something. Like, for example, what we do, we work with a lot of real estate agents. And so what we have our real estate agents do is we have them take pictures with their family and put it on postcards that they then send their mailers to all their potential clients, right? We can then turn around and pay their kids for that flyer that they put together. You can pay them up to $12,000 a year, right? And then now they have earned income to go put into a Roth IRA. And there's just so much more benefits that can come from that. Same thing with real estate properties, right? If you have any type of real estate investment or anything like that, you can actually get your kids involved and have them go to those properties with you and have them clean those properties with you or do anything like that or help go mow the lawn or pull weeds. And they can help you as young as 1 or 2, right? If they're 1 or 2, they can help pick stuff up and move it to a different room or whatever within that rental property.
And that could be classified as earned income.
Yeah,
at that age, that's crazy.
Yep, at that age, yep.
So no, like I'm not gonna get like child labor laws or anything.
No, because they're your kids. They're your kids. And so if you're doing it with other people's kids, yes, you'd probably run into some issues. But if they're your kids, yeah, you can.
Oh, that's a good idea. All right, so yeah, get them involved and then do a Roth IRA. Okay.
Yep.
Cool.
That's the best thing that we do with ours. There's other plans out there that honestly I'm not super familiar with. And Evan, so a guy I work a lot with, his name's Evan Van Auken. He's a Vanator on TikTok and Instagram. He has a lot of good ways that he pays his kids through different types of plans and stuff like that. So he's really good with all that stuff. I just haven't done a ton of research in that outside of like the Roth IRA option and paying kids through the business. So yeah, Vanator is he has a lot of good stuff on paying your kids and stuff like that. So
cool. I'll check them out.
Yeah.
No, but
that's
that advice
amazing
is
that
super
you brought
helpful.
him up because I think I've ran into this guy just on following of TikTok, and I think he's actually got a lot of TikTok videos out. And I go, "Ooh, I need to save this," and I send it to myself in a text message.
Yeah. Evan and I have been pretty close for a while, and I consider him one of my best friends. And he that guy puts out some freaking awesome content. Some really, really good content. Jump into just from like an overall business standpoint. He's fantastic. He does a lot of great stuff.
Yes, sir. Yes, sir. Any more questions?
I'm definitely gonna have to hit you up, Steven, because I do have like 6 businesses that I just kind of want to put in, and get the best out of it when it comes to taxes.
Yeah, let's go, baby. I love it. Yeah, I love it. So just in a nutshell, what you can expect from working with someone like us, if you come to us, again, I'm not a tax preparer. I am a tax and wealth strategist. And so what that means is I work with people who make a lot of money, who have a lot of businesses, and I teach them how to no longer pay taxes, right? So if you're coming to me, expect me to push you into real estate, because when you go buy a real estate property, if you set yourself
already
up
in there, buddy.
Love it. So if you set yourself up in the right way, we should be able to take about anywhere from 1/3 to 60 to 70% of that property in the first year that you buy that property as losses against your active and ordinary income. And so you literally get to a point where you buy 1 to 2 properties and you get your 3rd, 4th free. So there's a massive amount of benefit and tax benefits that come through real estate and oil and gas and investments like that. And it's why you have investors like like Jeff Bezos,
Grant
Elon
Cardone.
Musk, Donald Trump, Grant Cardone, that don't pay anything in taxes. They literally don't pay anything in taxes. They live off debt, and everyone calls them crazy for it. But it's how the wealthy work. You know, they have a different viewpoint of debt. They have a different viewpoint of tax code. Because if you can eliminate your taxes, you're talking about a 40% raise every single year. Like, what? And then you take that and you put it into assets that then create more income. So you can actually qualify for more assets from banks and from lenders. And it's a snowball effect, right? It's a massive snowball effect. So I love it.
You
I
start with
geek out
one
about
property. Next year, it's 2 properties. Next year, it's 4 properties that you can write off, 8, and it's just growing. Yeah, that's kind of what I'm doing right now. But I think you could definitely push me in the even righter direction.
I love it, man. I love it. Yeah, reach out to us. Jump on my schedule. We'll set up a 15-minute free consultation. I do 15-minute free consultations with everybody that comes to us. So we'll jump on a chat and talk about your situation and how we can help you, and see if we'd be able to make something work for you.
Beautiful.
So to sum it up, we learned about child labor laws. We learned about this is great info, man. This is really, really great info. This is extremely important because there are some day traders that do make a lot of money and they're getting taxed like crazy. So whatever we can do to find extra income by saving money on tax is so important. The preservation of wealth and using your money to make more wealth is so important.
For sure. I 100% agree. And taxes, I mean, don't give your money to the government if you don't have to. Just don't. There's no worse entity to give money to, in my opinion, than the government. They're not going to do anything well with it. And there's just a lot of talk around the wealthy paying their fair share and stuff like that right now. And the fact of the matter is, it's the middle class and lower class that get slammed the most with taxes just because of how the tax code is written. And we're too deep to undo it. I mean, I'm sorry, but the tax code, if you were to print it out and fill this entire room, you're talking about unwinding all of that to make it a more fair tax code. It's not going to happen. And so what you need to do as the middle and lower class is figure out how to leverage it to then bump yourself up and get rid of that tax liability. Don't complain about it. Just learn how to leverage it. It's literally a roadmap to becoming extremely wealthy. You just got to know how to do it. So.
All right. If there's any more questions, we're going to hold off for another 10, 15 seconds. Any more questions? Ask now or forever hold your peace. All right. So that was extremely beneficial. I loved it. I enjoyed it so much. Thanks, Sean, for jumping on. Thanks, Penny, Malik, for jumping on. Hope to see you guys next week. Hey, and Snapback, man, I really, really appreciate you taking your time to do this. It's great information, something to think about, something to definitely do research. He offers that 15-minute consultation. Take advantage of it. If last year you paid way too much on taxes, don't make the same mistake. Learn from your mistakes. And let's save some tax money. Let's make some money trading and investing. And we'll catch you guys next week on the next video. Thanks for joining me.
Hey, I love it. Thank you so much for having me here, guys. It's an honor to be here with you. Thank you.
Awesome time, guys.